Mechanical trading with CFDs. While there are many trading systems on the market, you want to be sure that the system you use is appropriate for your personality and risk profile. The best way to do this is to understand how to make, adapt, and test a system for yourself. What is a mechanical trading system? Mechanical trading systems are systems that generate trade signals for a trader or investor to take. They are called mechanical because a trader will take the trade irrespective of what is happening in the markets. Because all the rules are laid out, there's no subjectivity involved. This type of system can be back-tested over a range of historical data to see how well it performs. The system will address entry and exit conditions, stop-loss exits and position sizing. And in theory, this should serve to eliminate all biases and emotions in your trading, because you're supposed to follow the rules of your trading system. For instance, a possible mechanical system could be based on buying when the price breaks through a certain level and the relative strength indicator is below 30. It's possible to backtest this system for previous years and see how well it would have performed. If you do a simple search in Google for trading systems, you're likely to end up stumbling across hundreds, if not thousands, of people who claim to have found the holy grail system that you can purchase for only a few $100s. However, there are some things you should be aware of before you hand them over the credit card number and make that impulse buy. The truth is that many of these trading systems do in fact work. The problem is that most traders lack the discipline to follow the rules that go along with the system, which is why backtesting is essential. What everyone should take away from this type of trading is the idea that however you approach your trades, the whole thing should be repeatable. What this means is that you should be able to find the same type of setup again and again. You might reflect on your trading so far and think fondly of the big winner that you made on a hunch. But the reality is that this isn't something that you can readily repeat, so it can't form part of your trading system. Another truth is that instead of paying thousands of dollars on a trading system, you can actually spend your time developing your own system for free. Use that money you are going to spend as capital for your trading account. The last point is that creating a trading system isn't that difficult. What is difficult is following the rules that you set when you do develop your system. In fact, the main drawback of these systems is not necessarily that the black box doesn't work, but rather that the trader doesn't follow it through good times and bad. After a string of losing trades, a common response is to lose faith in the system and move on to another method. The problem is that this introduces a high degree of randomness. Without consistency, it's difficult to know whether winning or losing trades are down to you, your method, or just bad luck. The first step in trading is to try and remove randomness from your actions. This will not remove randomness from the markets, and no matter how hard you work, you won't ever get every trade right. You can take heart though, because often positions must be sold due to market movements that no one could have predicted. However, once you have found a method that's quite consistent in its performance, you should be able to overcome many of the negatives that are an inevitable part of trading.